when the market goes down, it's an opportune time for us to go in and buy stocks and do dollar cost averaging so that we can buy a little bit along. Certainly in 401k, it's time for us to put more money in it. There's a great times for us to do a much better job with our portfolio. Certainly rebalancing, because now my portfolio is out of sync. I need to rebalance and get myself back into sync with what my plan was. And certainly it's an opportune time to always put more money in it.
Welcome into the program. This is Financial Focus, brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter, now 10 straight years, and running the team from GulfCoast Financial Services, and founder and CEO John Kuykendall here with us, as always, helping us stay financially focused, focus on those goals, giving us the information and guidance to achieve them. John, we always appreciate the time, the information that you share, and a timely and relevant message, really wherever and whenever we are at in our financial progress, but a reminder that the market can be volatile, as we have seen recently. So today, discussing that market volatility and how to plan to deal with it.
Well, Peter, market volatility is something that we just have to expect. Unfortunately, when the market goes up, and we have the year that we had last year, and the first part of this year, everybody gets complacent. There was a lot of talk about a recession, which didn't happen, a slowdown, which didn't happen. So a lot of people are taken back by this. But, since 1926, according to an article by First Trust, the the S&P has been positive 72%, 73% of that time. So, from 1926 to 2024, 73% is not a bad average. I mean, a baseball player would take that in a heartbeat,
Sure. That's more than Hall of Fame numbers, right? But John, it's those other 27% of the years where the market is down that give us that angst, that worry, the pit of our the pit of our stomach kind of churns, and it's why we are hesitant to make the investments or make mistakes when those downtimes do occur.
Yeah, Peter, I've often thought that, Americans are taught to be winners. From the time we start playing Little League baseball or, girls soccer or whatever we're playing, we are taught that we want to win. And so a lot of people, I think, take this market correction as they're losing. And therefore they're losing and they're losers. And so they don't like it. And what happens is we can make decisions that are really not in our favor, because it's proven over the long haul, the number of days that we're in the market give us a much better return than the number of days that we're out of the market. So we have to stay focused and stay in the market. And that's all part of that financial focus or income plan, where we look at your risk, look at what we're doing with you, and try to give you peace of mind. It's your risk number. And I've always said that risk number is how I can sleep at night, whether the market's up or down.
Yeah. And that plan, ladies and gentlemen, is what is going to allow you to keep a level head and financially focused when market volatility presents itself. With a properly tuned and aligned plan, market volatility in many ways can actually present us with opportunities. So we talk about the reality of market volatility week after week on the program, on the podcast, but the emphasis is that you need a plan that addresses that and includes the fact that it is going to be a present reality now and into the future. Bottom line, there are many causes for volatility. We don't know what the cause of the next round of volatility or this one necessarily is going to be, but we know it is going to be there. And that's why that financially focused plan is so important. So if you would like to take advantage of that opportunity, or just to tune up and review and evaluate your current plan or investments, pick up the phone, give GulfCoast Financial Services a call, 386-755-9018, 386-755-9018. 386-755-9018, or you can visit online at gulfcoastfinancial.net, gulfcoastfinancial.net. John, do you think it is that psychology where we are taught to be winners that is the reason why, or at least attributable to the reason why we are also taught to take risk with our money, or is it just the necessity of growth that drives that risk?
No, I think we're taught to take risk, and so we want to be aggressive. But on the other hand, our inner psyche doesn't want us to lose, so we don't want to be aggressive. And so what we have to do, Peter, with that financially focused plan, we're diversifying the portfolio so that there's a certain amount in bond funds, bond ETFs. There's a certain amount in fixed indexed annuities to give us income, to give us the protection of the downside, and also fixed annuities and other components so that we can diversify the portfolio. It's really important that we don't have all of our money in high risk investments. And Peter, the S&P 500 is not it's 500 stocks, but 7 stocks make up 80% of the allocation in that S&P 500. So I'm really not getting a broad diversification. And so when Microsoft or Apple or somebody, one of the other tech stocks goes down, it affects the S&P 500 more than we think. So, we have to be more diversified than just using indexes.
And that is eerily similar to that tech bubble burst that we saw in the very late 1990s, where people were in general far overweighted in just one sector. And it sort of is now built into some of the indexes as they are weighted. So again, risk is going to be present and prevalent and in many aspects necessary to build our forward progress, give us the projection toward our financial goals. But John, is there any kind of guidance or rule of thumb or way to measure the appropriate amount of risk we should be taking and how much we actually are taking?
Well, I think, Peter, the one thing, where there is that old standard rule of 100 where you subtract your age from 100, and then that's the percentage that's left that you put in the stock market. So if you're 70, you're going to put 30% in the stock market and 70% into fixed investments or more conservative investments. And I think that some type of that rule is good, but I think every individual person has their own risk number. Some people aren't going to be happy even with 30% in the market, but some people aren't going to be happy if that's all they have in the market. And so what we have to do is figure out what your individual sleep number is. You remember that commercial where what's your sleep number?
And mattresses.
And yeah, the mattress people. And they were, my sleep number is different than your sleep number. And that's true with investments. My sleep number is a lot different than your sleep number because you're younger than I am. You have longer to make it up. There's a lot of things that go on. On the other hand, I'm educated in the stock market, had a lot more experience because of my age. And so I really don't mind taking some risk. So we kind of have to weigh those things together and come up with a plan that's appropriate for each individual investor.
As we look at trying to hone in and identify that risk number, John, the reason why there's kind of numbers on both sides of that is that there is an upside to risk and a downside to taking risk that we need to be cognizant of. And at the same time, there's an upside and a downside to safety with our funds and investing, or rather earning an interest rate as opposed to investing.
Yeah, I think, Peter, the thing is that we don't want to be so aggressive that we end up crashing our portfolio because we don't have time to make it up if I lose 20 or 30%. I don't want to have to make some decisions based upon what the market's doing. I want to make decisions based upon what my plan is, what I've set up ahead of time, and where I am. And so if I have a growth bucket, a fixed bucket, a short-term bucket, and a income bucket, then I'm going to be able to pretty well weather any market and not make knee-jerk reactions that are going to cost me money. I don't want to be like the guy who I asked him when he came in a year or so ago, and he said he was in the fixed account with his 401k. And it was earning him like 2%. And I said, well, you just went there during the recent downturn. He said, no, I went there in 2002. So, you don't 18 years or so of 2% growth instead of whatever the market was going to give him.
Well, that's John, we therefore, in order to keep a sane mind and psychological well-being, despite what we know is going to be the ever-present threat of market volatility. You gave a list before the program of a sound approach to volatility, including, of course, first and foremost, having a plan. That financially focused plan is going to help us to do, I think, several of these subsequent items. Don't panic, remain calm, have some accessible cash, be informed. And then there are some opportunistic pieces here when it comes to volatility, including rebalancing, contributing to accounts, moving more aggressive. But always a reminder, don't gamble with money that you can't afford to lose.
Right, Peter. And when the market goes down, like, it's an opportune time for us to go in and buy stocks and do dollar cost averaging so that we can buy a little bit along. Certainly in 401k, it's time for us to put more money in it. Those are great times for us to do a much better job with our portfolio. Certainly rebalancing, because now my portfolio is out of sync. I need to rebalance and get myself back into sync with what my plan was. And certainly it's an opportune time to always put more money in it. But like you said, we can't gamble with our money. And, if depending upon what stage you're at in life, we can't afford to gamble because we don't have time to make it up. So for a young person, that's certainly great. But for an older person, it's going to affect your plan. And I've seen several of our clients who've come to us who were greatly affected by the 2008 crash, and they has affected their retirement to the point that I really feel bad for them that they took those kind of losses because their advisor didn't get them out of the market.
You mentioned gambling, and another one of your rules, don't try to time the market. I liken that to going up to that roulette table and you see that it has hit on red repeatedly. And so naturally you're like, well, the next one's bound to be black, right? But that's not the reality of it. And so it is not possible to accurately time the market and get it right every time. And then another key component, John, that you said of taking risk and measured risk is protect your income. Can you talk about this relationship and dependence on protecting income and then the ability or the appropriateness of taking risk?
Well, we've talked many times on our show about the fact that we need to have an income plan. And the income plan takes into consideration how much protected money we have coming in every month, what our expenses are, and then what our shortfalls are. So we have to protect our income so that we can take care of our daily needs and the things that we have to pay for, car insurance, homeowners insurance, those things. And so we don't want to be in a situation where we have to sell in a down market in order to make up for the income. So what we like to do with our income plan is figure out what your income shortfall is, and then figure out a way that we can protect that by doing some things with annuities and life insurance, and then giving you that growth bucket that I think, Peter, is what we're talking about here, is going to be the part that I can be aggressive with. I can lose a little bit of money and not worry because I can let it grow back, because I'm not pulling out of it in a down market and hurting my portfolio. But certainly the income is always the most important thing in retirement, Peter.
And John, that is one of the strategies that you mentioned about hedging volatility, that there are ways to protect against or hedge against some potential wild swings in the market, particularly on the downside. We sometimes like the wild swings up, right? NVIDIA has been a crazy one this year, but those wild swings back down, there are some ways and methods and strategies to hedge against that. And investors may want to explore these if they are not comfortable with the market completely determining their outcome or their projected path forward.
Well, that's right. We want to make sure we have excess cash. We want to make sure we have an emergency fund. We want to make sure that our bonds and fixed income funds are yielding what we need to. So we don't want to just sit there and not work the money. We want the money to work with us. And there's also a thing called tactical, Peter, where I'm not going to time the market. But on the other hand, I'm not going to let a mutual fund or an ETF or a stock go down 20% and just sit there and ride it. I would rather get out and then come back in if that's the one I want. 9 times out of 10, it's not, but if it is, then that's fine. But we need to make sure that we've hedged our bet as far as making sure we have the income. I don't want to take money out of my growth bucket in a down market. I want to have all my eggs spread out so that I can take care of all of my income needs and all my short-term needs. And there are certain things, Peter, in life that happen. The car breaks down, you need tires, whatever. I want to make sure I've got money set aside that's in a liquid fund that I can get to take care of that.
Why, John, what allows us to take risk, you define a couple different types of protections that are also necessary for taking risk. And that is to have some dollars that are principal protected and then have income protection in place as well.
That's right, Peter. We need to have both. We need to make sure that we're diversified, that we're not all in one type of investment, and that all of our money's not in one stock or one mutual fund or ETF.
Well, no one wants to suffer market losses, and yet no one can accurately time the market. And ultimately, we know that utilizing the market is one of the best opportunities and vehicles for long-term growth and appreciation above inflation. So losses and volatility along the way are kind of a natural part of the experience. Considering some protection for certain aspects of your finances or certain portions of your money does not necessarily mean that you are giving up on gains. In fact, John, it is what is necessary to allow yourself the opportunity for growth via taking some risk with your money. The question, I guess, John, is how prepared are we for the next downturn? And that really is going to boil down to what kind of plan we have in place.
That's right, Peter. We have to have a plan in place so that we can weather these downturns. We can celebrate the good times, but we can also celebrate the bad times because it's a buying opportunity. It's a time for us to make changes in our portfolio, to buy things that we couldn't afford before, to get into different markets that we couldn't get into before. But we don't want to just have a half-hedged plan that we're just going to invest in all kinds of different things. We have to have that income plan to take care of us during these times. The down market is not necessarily bad. How many times, Peter, have you heard somebody selling because the market was down and then the market came back the next day?
Yep. They say some of the best days in the market happen directly after some of the worst days.
That's right.
And we've seen that to prove out to be true. Hence the saying is very common because it does happen that way. It seems more often than not.
Right. It does. It's amazing, Peter.
Well, John, we always appreciate the time. And as a reminder, ladies and gentlemen, volatility is going to be ever present or potential with investment in the market. That's why we've got to have that solid financially focused plan in place. John Kuykendall, the team at GulfCoast Financial Services are there to help you put that together. Continually, repeatedly named best of the best in financial services the last 10 years straight and running by the readers of the Lake City Reporter. Give them a call and find out why and get that financially focused plan put together. 386-755-9018. That is 386-755-9018. 386-755-9018. Get the plan in your hands in 2024 to make this year and every year beyond as impactful and positive as it can be for your financial well-being and progress toward your goals. John, we always appreciate your time and being a resource for so many proactive savers and investors. Thank you.
Thank you, Peter. Great to be here. See you next week.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services Inc., a registered investment advisor in Florida. GulfCoast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.